I mean, the year can be different for different companies. Home Depot ends its year sometime at the end of January. But let us say a company starts its year on January 1, ends the year on December 31st. So that means you have already put the blinkers here. So we've said, okay, fine. So in our example, 2010. So January 1, 2010 to December 31st, 2010. So during that period, whatever happened to revenues and whatever happened to expenses, that will tell you what happened to profits that year. Yes?
So you're saying the expense is the price that you paid for the items that the customer walked out with?
Perfect. Perfect. I couldn't have put it any better.
Okay.
Very nice. Very nice. That's exactly right. That's exactly right. Absolutely.
I'm trying to get it.
That's exactly right. So that is the classic definition of cost of goods sold. It is the cost of the goods that got sold. So if Walmart kept on buying the $20 items throughout the year and it didn't sell a single item, then their revenues are zero and the cost of goods sold is still zero. So you can say, oh, what about all the $20 that they have to pay? Well, that's all in liabilities. It's sitting there as something that they owe, but it doesn't affect their profits. Okay, so now we are done with 2010 as far as profits go. We'll do this later. We'll complete this exercise in a comprehensive fashion later. 2011, continuing, the example continues. In 2011, no more lawnmowers got sold, nothing happened really, except that the customer paid the $600 and Home Depot paid the $500 to the supplier. Remember, Home Depot owes $500. The fact that they sold only 4 doesn't matter. They still owe the supplier $500. So in the year 2011, they collected the $600 from the customer and they paid the $500 to the supplier. Now the same question. How much profits will Home Depot report in 2011?
$100.
Profit?
Profits.
Minus.
Revenue minus expenses?
Yeah, of course. That's always the thing. Do they have revenues in 2011?
No, they
No.
didn't.
Good, good. That's it. This is just like a machine. The machine has to look at, did they earn anything in 2011?
No.
Did they, so did they meet the, well, if they already, that is gone, so that means no revenue. Right? So therefore revenues are zero, so that cannot be cost of goods sold because nothing got sold. So therefore in this case, no expenses, no revenue. So profits for 2011, so for 2011, revenues are
negative.
zero, expenses are zero, so profits are zero. Okay? So the 2011 situation is that revenues and expenses are both zero, and so therefore there will be zero profits. Okay? So let's go to 2012. 2012, they are getting desperate to sell that remaining lawnmower. So they decided to sell it at cost. But you have to pay cash, no credit. So somebody picked it up at cost for $100. Okay? The remaining lawnmower got sold. Okay? So now, what is the profits for 2012?
Zero.
Why?
No.
First of all, let's do it the same. Let's do it the mechanical way. How much is revenue for 2012?
Wow.
Okay, 100. How much is expenses?
Zero.
Perfect.
It has to
Perfect.
minus.
Therefore, profits are zero.
What you sold it for is your expense.
No.
No.
What you sold it for is your
No.
revenue.
Sorry.
The cost of what you sold is your
Expense
expense.
also, no?
In this case, you already know from 2010 that the cost was $100.
And you sold it for $100.
You sold it exactly for the same $100. So what you sold it for is your revenue. This is what. So when you said,
Like in this one, 2010, what you sold inventory for was $400, so that was your expense, like in 2010.
But you
No,
already
it's not the
paid for
same.
No,
in
you bought it
2010, what you sold the inventory for is how much?
400.
No.
Sorry, 600.
Ah.
I see what you're saying. Well, I'm saying, what the company sold it for is their expense. Todavía no. That's what I'm seeing though.
Cost of goods.
Yeah.
It's not right.
It's wrong.
So
Okay.
the cost
You will
of
get
what they sold is the expense. The company's cost, the cost to the company of what they sold is the expense. But what they sold it for is the revenue.
Revenue. Okay, see, I'm saying backwards.
¿Entendiste?
Now you got it. Good. Very good. Very good. Okay?
¿Entendiste?
Why are you putting an expense of 100 when you already put 500, or you put 400?
Because of the
You
goods.
carried.
The goods, the goods.
So basically in 2011, they didn't pay the whole bet.
So
In
altogether, they,
2011,
They,
they paid.
that's a bad
Okay,
business.
so,
Yeah.
so what happens to
So
the,
that doesn't affect their profits. That's the point.
They're not getting a lot of
The
profit.
fact that you owe
I
me
don't like
money
that business.
and you pay me the money later on, that does not affect profits. Profits arise when you have a sales transaction. There must be a sale for you to have a profit.
If not, you have inventory.
But
If not, you have
you
inventory.
have inventory, exactly. When you are accumulating items to sell, at that point you are accumulating inventory. That's an asset for you.
Correct.
You own it, it's an asset for you.
Correct.
But when that inventory item gets sold, now you're earning a profit, which is the difference between what you sell it for and the cost of what you sell.
So
There
the
you go.
profit in the 2011 was 200.
2011, it cannot, there can be no profits at all. We just discussed that.
you
There
didn't
was
sold
no
it.
revenue, no expenses, no profits or zero in 2011. There is no revenue, no sale happened.
You didn't sold
He collected 600.
There was no sale, that's not a sale.
so what happened to
A
the,
sale is when a customer walks away with an item. The customer walked away with an item from the store only in 2010 and later on in 2012. In 2011, nobody got anything from Home Depot. The transaction, what happened was a settling
What
transaction.
happened was,
You settled as Home Depot, you settled your dues with your suppliers, and I as your customer, I settled my dues with you.
and so what
There was
happened?
no sale. Exactly. Perfect. Now your assets are turning more liquid. Absolutely correct. Absolutely.
So you
how
have
do
a
you account
cash
for the
flow.
$100?
Sorry?
Cash flow.
Yeah. So, yes, perfect. So now, see, look how easy it is. So already you have already talked about cash flow.
It's not
So
even
in
what I do.
2011, even though you did not have a profit, what do you have? You have cash. No, there was no selling, but there is cash flow. Because cash came in and cash went out, even though there was no
Even
profit
if you're
involved.
if you're not making profit, you have
No,
cash.
you did not. You sold it in 2010. That's why the period is extremely important. You sold something. Yes, that something was accounted for correctly in 2010.
But in 2012, I didn't sell anything?
2012 is different. In 2012, you had a sale and you had a cash flow because the customer paid the $100 in cash. So there was cash coming
In
in.
2011, I didn't have any.
2011, what you did not have is the sale, but what you did have was the cash flow.
Guess when I received the money.
You got the 600, you paid the 500. So there was, there was 600 coming in, 500 going out in cash in 2011. So as she correctly said, there was cash flow in 2011, even though there was no profit. Now you are getting into the heart of the accrual system. This is exactly what the accrual system is. The accrual system measures profits as distinct from cash flows. So you could have and why is that an important matter? Because we have a period dimension. We put our blinkers on. This is the period. We define the period. Anybody, you can define the period any way you want. I mean, in the sense, you can't define a period as 5 years, but typically you define a period as at 1 year or less. So once you define the period, now you start saying, okay, in this period, was there profits? As independent of was there cash flow. So you could have profits in that period but no cash flows, or you could have cash flows but no profits, or you could have had both, but which is different. You could have different profits and different cash flows in that period. Right?
To summarize,
good.
it's not a good business. That business.
Which one?
It's not a good business.
Why?
Because in 2 years you only have a profit of $200.
Yeah, but you're not selling one thing.
But that's all. You have sold everything that you had.
Anything that
And
makes you a
then you don't have
profit is
money
good
to buy again.
Ah, I mean, this example is generated only to illustrate the accrual concept. That's the important thing. So in the accrual concept, now if you were following the cash basis, you would say in 2010 there is no revenue, there's no expenses, so there are no cash profits in 2010, and in 2011 you will say there was a cash profit of $100, and in 2012 there will be a cash profit of another $100. But that's not accrual. So GAAP does not allow you to do cash basis accounting. So if you're following GAAP, you are not doing cash basis. Yes.
Professor, let's say Home Depot decided, I guess it was, it was scared and they decided to sell the lawnmower for $50
In the third year?
in the 30 years.
Okay, 2012. Yeah, sure.
So you would have minus 50.
So what is that? It's a loss.
A loss. Okay.
So you would report a loss of $50 in 2012. Correct. There you go. Okay, revenue, again, same thing. Revenues are 50, expenses are 100, so the loss is $50. Any question?
Doctor, you said that the most important thing is to be comfortable with the jargon. This is like one of the things when you boot camp, you jump to, because it's comfortable with accounting. The jargon basically is revenue, expenses, liability. Is there any, like, what I'm saying is there anything, like, is there a listing of terminology that we should be more familiar with to help us with this?
I'm here for you. Of course.
Get the
Just for
terminology
you.
as you move on.
You're the best.
And we'll get it again and again and again, so it will be easy.
Just for you.
We'll see this revenue thing so many times,
Sí,
and
sí,
expense
aquí no me
thing so
venga.
many times, that by the time you do your
Aquí no me
project,
vengas con una
it will be
colombiana
child's
en la
play.
historia, ¿ok?
No, no, we're not going to that.
Yeah, okay. Any questions on this? Okay,
New Orleans. New Orleans.
Ay, no.
so,
But thank you.
Negrita.
Está bien. Que me enduzque la vida. No
Te
puedo.
la endulce.
Endulce, que se enduzque. Wow.
Ah, bueno, yo verás. Te paso las notas y todo.
No, just with that, I'll take mine.
No, but I can do notes. With shapes, or I can give you the...
okay, I'm gonna, so we'll get into all this later on, and the profit comparison, key message. So let's go to the key message of accrual accounting. Profits are not determined when cash changes hands, but by the economic nature of the transaction. Since GAAP rests on accrual accounting, the profits do not necessarily represent cash flows. We need an important financial statement other than the balance sheet and the income statement, which is the statement of cash flows. So now let's go back and just in some sense complete this, and then I'll take the more detailed example.
Dile que tengo hambre.
So
Huh?
Dile que tengo hambre.
Huh? Yeah.
So now let's look at all the financial statements in each of the 3 years. And it's going to be very simple because we have only 2 or 3 transactions total. So let's take it one at a time. So what we will do is for 2010,
We have here transaction analysis example
yeah,
and reporting of transactions. Is that today's course or is that tomorrow?
no, it's the 2 files will be discussed both today and tomorrow.
Okay.
Today we are on the recording of transactions.
Okay.
So
Which
this
is
is the
the most
PowerPoint
important
slide.
part.
Okay.
The other one is a Word file. Okay. Microsoft Word file. Okay. So we already saw. So let's look at the. So let's take 1 year at a time and complete all the financial statements. So 2010. So we'll start with 2010. So income statement. Income statement for 2010 will show the following. It will show revenues, $600, and it will show cost of goods sold, which is an expense.
500.
So I'll just put a star here and say it's an expense. That's $400. And so you will have profits, $200. So that is the most critical financial statement, or one of the most critical financial statements that you're ever going to do. The stock market pays extremely close attention to profits. So it is now well documented in the literature that the stock price reaction to profit information is the most significant. Every time there is an earnings announcement, the first thing they do is, okay, how did Wall Street react to this? So therefore the profits is the key number for I mean, not that other numbers are not important, but for some reason the stock market pays a lot of attention to the company profits in any given year. Alright, so that is the income statement. The second financial statement that we do is what we call as the statement of retained earnings. Okay, since I have not really talked about retained earnings, so let me hold off on this for a while. Then we go to the balance sheet. The balance sheet is as of a particular date, as opposed to the income statement. The income statement is what happened over a period of time. Okay, the balance sheet shows you exactly what the situation is as of a particular date. Okay, so in this particular example, so the balance sheet lists three things. It lists assets, it lists liabilities, and it lists owner's equity. Sometimes it's also called stockholders' equity. So assets, liabilities, and owner's equity. Now, balance sheet as of 12/31/2010. If you look at this balance sheet, what assets does the company have at the end of the year? What are the things that the company owns
Inventory?
based on just what we have discussed so far? Does it have any cash at the end of the
Cash,
year?
inventory?
$100.
Does it have $100 cash?
No, in inventory.
2010?
At the end of 2010, does the company have any cash in this
Oh, no,
example?
not 2010, my fault. No.
Right?
Yeah.
Nothing. So what other asset does it have?
Inventory.
Inventory.
One item.
Okay, so the company has inventory. How much is the inventory?
$100.
Perfect. They had $500 of inventory, $400 already got sold, so they have $100 of inventory still left. So
Yes,
they
yes.
have $100 of inventory. Does it have any other asset?
Maybe, we don't know.
No, just based on this example. Based on this example, does it have any other asset? What about the money that the customers owe them?
Accounts receivable.
Is that an asset?
Yes.
You own that. You can sell it.
Wouldn't that be a liability?
Sorry,
No, liability.
you
is
can
something
sell
that
the
you have to pay.
receivables to somebody.
To collect.
The collectors, you can
Aquí
sell the
sí.
receivables.
Aquí sí sé.
Let's say your customers owe you $600.
Mhm.
You don't want to go through the trouble of collecting the money. Somebody, you can sell it to a collector. Maybe they will pay you $500 cash for that. They will keep $100 for their trouble, and so you can sell it for $500. So
Mhm.
now you have cash. So that means that's an asset that you own.
Yes, yes.
$600 of receivables is also an asset. So I'm going to write it on top of the inventory because the convention for listing the assets is in the order of liquidity, meaning that liquid assets go first and the non-liquid assets go later. So we'll start with accounts receivables. I'm going to abbreviate it as AR. So your accounts receivables are how much?
$600.
$600. That's the money that the customers owe you. You sold the 4 lawnmowers for $600 and they have not paid you yet. Excuse me? They have not paid you yet. So the $600 is the receivables that your customers owe you. Okay? Any other asset that you can think of?
No.
No. So total assets are $700. Right?
2 lines.
Now let's go to liabilities.
$500.
Does the company have liabilities?
Yes.
Perfect.
$500.
They owe money to the supplier. So therefore, we call this accounts payable. Accounts payable is $200. Sorry, $500.
500.
The accounts payable is $500.
That's what they owe.
Yes, that's exactly right. $500 of accounts payable. Any other liability? Any other money that the company owes? other
No.
people? None, right? So they don't owe any other money to anybody else. So the last is owner's equity. The owner's equity now is represented by the profits, because we don't know anything about they bringing money into the business, so we can't use that. But we do know the second item of owner's equity was profits.
Mhm.
So we don't call it profits in the balance sheet, we call it
Equity.
a term that we use for accumulated profit, that is profits that got accumulated over time. We use the term retained earnings. Retained earnings is a very, very important component of owner's equity. So we use the term retained earnings to say all the profits that the company makes. Since the company has been, we don't know whether they were in existence before 2010, so we'll assume that they started their business this year. So the retained earnings at the end of the period would be $200. This is the amount of money that the owners own. This purely belongs to the owners. This money belongs to the suppliers, because you owe the money, they will be paid. But this 200 is completely the owner's money. Okay? That's it. So now we can see the important relationship on the balance sheet, which says assets equal the sum of liabilities plus owner's equity, always. This relationship can never be violated, and we will see that when we look at the more detailed transactions, how we will record the transactions in a way that this relationship is never violated. So all the liabilities at any point in time in a business, the total of the assets must be equal to the total of liabilities and owner's equity. Okay? So that's what we see here. The total of the assets is 700, and the total of liabilities plus owner's equity is 500 plus 200, or $700. Now let's go to 2011.
I have a quick question.
Yes, sir.
What happens if you're out of balance?
If you cannot be out of balance.
You can never be.
You can, because you will record every transaction to not violate it. So the sum of all the transactions cannot violate it.
Okay, that's okay.
Yeah. So unless you make a mistake in recording a transaction where you did not record it correctly, and then you violated the equation in one transaction out of like 10,000 or something, then yes, now you'll be out of balance.
Find that once you get it.
Well, not really. These days with computer packages, they won't even let you go through with the recording if it violates this equation. The package will keep on warning you that this is not right. So you will know, pretty much. Okay. So now we'll talk about 2011, and then we'll go to 2012. We'll complete it. Okay. Now let's also finish up. This is the income statement, and this is the balance sheet. So let's do the income statement and balance sheet for 2011. So income statement for 2011 will show revenues we already saw was 0, expenses was 0, and so profits
It's 0.
are equal to 0. Revenues minus expenses, so profits are 0. Now let's look at the balance sheet as of 12/31/2011. Now again we'll follow the same thing, assets. What assets does the company have at the end of 2011? Do they have cash?
Inventory.
And they have that $100.
$600 collected.
$600,
I'm sorry, say that again?
$600,
They have $600 in cash?
$600 in cash and then collected from the customer.
No, they pay 500 from it, sorry. So they have 600, but they pay 500, they only have 100 left. No, I'm sorry.
Since they not have any of that?
I don't think
It's
that-
cash.
Do they have? So focus only
They
on
don't have
cash.
any
We'll get
accounts
to-
receivable.
We'll get to every item of
Yeah.
assets later. Let's start with cash. Does the company have any cash at the end of the year 2011?
Yes,
Yeah.
it's $600.
I think
How much cash does it have?
$600.
$600.
It has 600?
No,
I don't know.
it has no cash.
It has no
It has
cash.
no cash?
$100.
What about the 600 that they collected?
But that's not from cash, it was not cash.
It is cash.
When you collect money, it is cash.
It is cash. But you have to deduct different accounts, so your balance
It is
will-
money.
It is money. It's cash.
Somebody wrote a
It's
check
cash
for-
flow.
somebody wrote a check for $600 to you. So
It's
that is cash
liquid.
to you.
It's liquid.
So you have 600. What about the 500 that they paid to the supplier?
You have to deduct it from the account.
So you take it out. So how much cash do you have?
$100.
Thank you. That's all I'm asking. So therefore, your assets.
In 20, like what threw me off, I mean, apart from like my whole life, in assets.
Plus $100 inventory.
And inventory 100, so they
Ma,
have 700.
what they have in inventory.
Yeah.
What they received plus the,
No, the only thing is that you have to pay.
Well,
I mean,
the
you
thing
have
is-
paid $500.
Okay, see, I can only
And you-
respond to what threw you
You're
off
going
in account.
negative. So
As
now
far as the
you're
life part
positive
goes, you
with
need to find a different
$100.
answer for that.
Because you're deducting
So
the
let
minus
me-
$500 that you paid
No,
to
I'm not.
the supplier.
I don't do marketing.
That too, that too.
so it's $200.
That's $200.
Listen, let's start with, forget about this. I mean, see, when I pose the question, I pose it for a reason. You know, depending on where we are in the course, I ask the question so that you can focus on that one part. So that, you know, we get over that and then the success builds on itself. So when I say how much cash they have, don't worry about anything else. Just look at the year 2011. In 2011, how much cash did they generate? Net.
$100.
100. Net. $100. When going into 2011, did they have any cash? Going into 2000, at the beginning of 2011, did they have any cash?
No.
Zero. So during the year they generated $100 of cash. So how much cash do they have at the end of the year? $100. Thank you. So cash is $100.
Plus inventory.
Hang on. We'll take one at a time. Now, receivables. Do they have any? Remember, we already said accounts receivable is an asset.
Yeah.
So now let's ask again. Are there any accounts receivable
No.
assets at the end of the year 2011?
Sir, no, sir. No.
No. Why? Because they collected the money, so it's no longer receivable. So there is no accounts receivable at the end of the year. End of the year 2011. Yes? No? Maybe?
Yes, yes.
Slightly. Okay. So now the next item, inventory. Do they have inventory at the end of the year?
Yes.
They still have the
Yes.
100. The unsold
Yes.
lawnmower is still there. So therefore, their inventory is $100. So their total assets are 200. All right. Now let's go to liabilities. We talked about one liability here, accounts payable. Do they still have that liability?
No, sir.
Good. They don't have because they paid off the supplier. Right? It's paid in full, so that liability does not exist. Do they have any other liability?
No, sir.
So now let's go to owner's equity. So liabilities are none. So let's go to owner's equity. Remember we talked about retained earnings of $200. What happened to that? Still there. Right? Nothing happened to it. They didn't pay a dividend to themselves. It's still there in the business. That $200 profit is still there.
Yes.
So therefore, that is owner's equity. The retained earnings of $200 is still there.
Boom, balance it out.
It's not like we wrote it to balance it out. It's just that we wrote it correctly, therefore it balances
I was
it
trying to
out.
figure
That's
out.
right. You got it.
I was like, we have the balance. Like, where are we gonna get the money from?
There you go. There you go.
And so we didn't pay dividends or reinvestment to the company, so it's still there. in the
It's considered a reinvestment. I mean, in the sense that since you didn't pull it out, it is considered staying in the business. That's why it's called retained earnings. The term,
The owner?
no. Retained earnings is, so the term earnings in the United States context, they use the term earnings to also mean profits. So profits and earnings, they mean the same thing. Okay? So therefore, retained earnings means profits that were not pulled out. So $200 of profits have not been pulled out.
When you first started the thing, you said, oh, the company started in 2012, so there's nothing in the back. But if this company was 5 years old, it's still remain earning for 5 years, and that stays there as owner's equity.
There you go. As part of owner's equity.
When you sell the business, that goes into the capital of what it's worth.
Well, it should be, hopefully, unless the buyer of the business might say that all the profits that you're booking here, they are frivolous because you never collected the cash. So if you're going through cash problem, they may not recognize the profits. See, think of it this way. I mean, you can credit card company. You keep, issuing credit cards to customers who will not pay, or you have not verified their credit worthiness, and you have started issuing cards left and right. Okay, so then what happens? They charge on the cards. All the charges that they put on the cards mean profits to you. When they charge money on the cards, what is that? It's profits to you, because it's the money that you make, because the merchant, okay, is paying you a fee for the use of your credit card. You get the fees from the merchant. So when they charge the card, but then they have to turn around and pay you the money that they owe. Correct or no?
Yes.
Right? But if they don't pay, what happens to all the profits? Poof, gone. There's no cash flow. Profits have to get converted to cash. If they don't get converted to cash, then that retained earnings becomes a meaningless number. So you may not get value for the retained earnings if your cash flow is not good. But that we are talking about selling the company. So we're not there yet. All right. So we are done with 2011. Okay, by the way, they said something about about food. I see that some of you are going. So you guys want to take a break?
Yes.
Yes.
No, see, we are supposed to end at 9:30.
What? But no.
No, it's fine. No, I just want to have a understand. What time is it right now? It's already 8:30. 8:15. Okay, then let's finish 2012, and then we'll take a break.
Okay.
Is that okay?
Yay.
Yeah, but again, please stay with me till we finish 2012.
2012.
All right. So finally,
2011.
2012. Well, we already saw for 2012 the revenues are $100,
Yes.
expenses are $100. This is the income statement for 2012. Okay, revenues are 100, expenses are 100. So your profits
0.
for 2012 are 0, right?
Yes.
Now let's go into the balance sheet. In the balance sheet, let's start with cash. How much cash will you have at the end of 2012?
0.
No,
$100.
Okay, how much cash? Hang on. Everybody, just calm down. Cash. How much cash did you have at the start of 2012?
200. 100. 100.
12/31/2011 is the same thing as 1/1/2012. At the beginning of 2012, how much cash did you have?
100.
Your bank account will show $100 in cash. I mean $100 in balance. So you have $100 cash going into 2012.
So you have
Now,
$200.
how much cash will you have at the end of 2012?
$200.
Where did this 100 go in 2012? You say 0. But you have to see, did you pay any money?
No.
Did you write a check?
No.
We're talking only cash. What happened to cash in 2012? Did your cash go up or down?
Up.
It doesn't matter where it went. Did your cash go up or down?
Up.
By how much?
$100.
By how much? 200? You got $200?
Oh, inventory 100, no, cash 100. Because you have
What?
inventory minus cash.
No.
Okay, you started with 100, you gained another 100, you got 200.
Perfect.
Yay.
Perfect. Thank you very much. That's perfect. Everybody agrees?
Yes, sir.
You started the year 2012 with $100 cash. In the year 2012, you sold one lawnmower for $100 cash. So that's an additional $100 cash in your hands. So you end 2012 with $200 in cash. Yes or no?
Yes.
Is it because you're hungry?
Yes.
$200 cash. We're looking at your assets. Are there receivables?
No.
No.
Are there inventories?
No.
That's it. That's all the asset you have. Right? So your total assets at the end of the year balance sheet as of
December
12/31/12,
31st.
cash is $200 and there are no other assets. What about liabilities? Do you have any liabilities?
No.
No, there was no liability. You never incurred a new liability during the year, so that's fine. There's no
3
liability.
years to make
And what about
$200.
owner's equity? Still 200. Now you got to think. There was a sales transaction. So you want to make sure that there was no profit other than zero. I mean, non-zero profits during the year would have increased your owner's equity.
Yes.
But there was no non-zero. The profit was actually zero. So therefore your liabilities are not there, and your owner's equity is still 200, which it was at the end of the previous year. So during the year, nothing happened to change the owner's equity.
2 years ago.
Right?
Yes, yes.
Yes, no?
Yes, sir.
Good. We made excellent progress for the first 1.25 quarter hours. I think we've done very well.